Hey guys, welcome back to the 5th episode of the Friday Ticker. In this episode, I'm going to go over short-term gains versus long-term gains and what the implications are from a tax perspective. So let's get into it. Now, I want to give a shout out to one of my longtime subscribers. His name is JB Caudle Knives. Shout out to you, JB. He had a suggestion for me to do a video for the Friday Ticker comparing short-term gains versus long-term gains when it comes to selling stock in the stock market and making a profit. Okay, there are tax implications depending on your income levels that you might want to consider before you sell a stock too early. So let's get started here. I've got my good old iPad here, and so we're going to write down some things. I did pre-build a few slides here that we can write on and do some calculations with a hypothetical gain in the stock market. So let's get started here. Now, let's first go over what short-term gains are versus long-term. So short-term is if you sell a stock less than 365 days, okay, you're going to fall into this bucket of short-term gains. And what that means is the government is going to treat it like ordinary income. Okay? Meaning it's the same thing that your employer taxes you at. Let's say you make, $100,000, whatever that tax bracket is at is what you're going to owe for these short-term gains, okay? And we'll go into all those brackets and we'll do the calculation as to what you're going to owe, okay? So that's short-term. And then anything above 365 is long-term, okay? And then there are 3 brackets to long-term, okay? And we'll go over those brackets. We'll run the calculation and do the math, and then you'll understand how this all works. It's pretty straightforward. Good old Uncle Sam is going to get their cut. That's the the name of the game with the government. They're going to get their cut. Now, there is some exceptions, which I'll go into at the end of the video. So let's go back here, and let's go over short-term capital gains. So I've pre-built this kind of template, and so yeah, let's take an example of $10,000 in gains in 2025. Maybe you were smart and you called Donald Trump's bluff in April of 2025 and you bought the dip on April 7th, Liberation Day. You were smart, you called the bluff, and you made $10,000. Okay, it was a great year for you. Now, unfortunately, Uncle Sam's going to get their cut. So what I've got here are the 7 tax brackets. You got the first tax bracket here, second, third, fourth, fifth, sixth, and 7th. Okay. Now we'd all love to be in the 7th tax bracket, wouldn't we? Making over $626,000. That would be nice. Okay. But let's be realistic here. Okay. Most of us are probably within the between 1 and 4 for the most part, okay? The people who are in 5 and 6 and 7, they're the elite. They're making the big bucks. They're probably, VPs, directors, CEOs, things of that nature. That's where they're at, okay? Now, the first tax bracket is 10%, okay? And for a $10,000 gain, you're going to owe $1,000, okay? The second tax bracket is 12%, okay? So you're going to owe $1,200, okay, for that tax bracket. The next one, it's pretty much a bump up, 22%. I mean, that's kind of crazy. When you're talking from 48,000 to 103, that's a big jump for a lot of people. And so that one, you're at 2,200. Now you're really talking some big dollars when it comes to tax implications on a stock. And then after that, we're at 24%, a little tiny jump. So 2,400 you're going to owe. And then we're at 32% when you get above 192. Okay, now we're really talking here. Now it's Now it's hurting you because you went up 8% from 24 to 32. That's a big jump. So you're talking, $3,200 on a $10,000 gain. Now it's really starting to hit your wallet at the end of the day. That's almost half. So, and then we've got 35% for the next tax bracket above 250K, and you're looking at 3,500. And then the final one is 37% at 3,700. Nearly half of your money, half of your 10 grand goes to the government. Okay. And this is why, high net worth individuals, they really take this into consideration because, anything above this 197, if you make over $197,000, this is for single, not married, basically, just single taxpayers. If you're married, it's going to be higher than that, the threshold to meet these tax brackets. But if you look at it, anything beyond that 24%, that is a big chunk of change when you think about it. And for all the risk you take to make $10,000 and then for the government to take $3,700, I mean, that's going to eat you alive. I mean, if you make over 600K, you're going to feel that even still, and these people, they're probably working with more than 10 grand in gains. They're probably at $100,000 in gains. So you're looking at $37,000. So be aware of that. It is going to be an implication, but even still, even below this, this can eat you, especially even these two. That's a decent amount to hit your wallet. So consider this when you're going to sell a stock less than 365 days. Okay, these different brackets on a $10,000 gain. It could happen. You put in $40,000 on a stock and it goes up 25%. Let's say earnings comes through or Liberation Day is not a real thing, and you make 25% in less than a year. That happens a lot in the stock market. So be aware of this. So let's go now to long-term gains, and then we'll kind of flip back and forth. So long-term, again, is greater than 365 days. You got to hold it longer than a year. And then again, let's use this example, $10,000 profit. Now, the first income bracket is from 0 to 47,000. Okay. You pay 0%. Okay. So if you didn't work that year and maybe you had an after-tax brokerage account with $50,000 and let's say you bought NVIDIA and it went up 25%, you sold it, you're going to collect the full $10,000. Okay. Tax-free. That's kind of crazy. Again, you have to hold it for longer than a year. So, that's kind of one of the rules. You just got to hold it for more than a year and you can sell it and collect the full $10,000. Maybe you got laid off and you got some long-term profits and you need the money. That could be a reason to sell some shares. If you're desperate for money and you got long-term gains and you don't go over the 47,000, that's a pretty good deal as far as not getting taxed. Of course, it sucks that you don't have income. Okay, so I'd rather have the income. So let's put it that way. Now, after 47, it's a big gap. 47,000 to 58,000, you're looking at 15%. That's the sweet spot which most people get taxed in the stock market when they're taking gains. And so for $10,000, you're looking at $1,500 is what you're going to owe the government. Okay. So then after 518, you're at 20%. And this is what your high net worth individuals are at. And so you'll owe $2,000 to the government. So as far as you can definitely see where the ultra wealthy, if they have, or high income earners, at 20%, that's a steal when you think about it compared to, even after 48,000, over here, you're above 22% at 48,000. So the rich, they get a steal deal over here. If they make over 518,000, they only get taxed 20% on a long-term gain. That's exactly why they take advantage of it. Now, as far as kind of your everyday investors who probably don't make near 518, you're going to be probably 15% versus most likely right here, 22 or 24%. So, if you look at it, let's see here, let's just say 2,400. Let's just go with 2,200. 2,200 versus 1,500. You're looking at about a $700 difference if you go short versus long as far as tax implications on a $10,000 gain. That's a big gain for anyone who's making under $100,000. $10,000 is a big gain. Is $700, worth the wait? Maybe, if that stock, let's say, you're up 25% and you're at like day 325, so you got to wait another 25 days for $700. That might be worth it. Now, if a stock goes up, let's say 50 days into your investment, up 25%, you put 40 grand in and you made 10 grand. Is that $700 worth you holding another 300 days? In my opinion, the answer is no. If you're going into and out of positions, and you've made 25% and you're not really like super bullish on the stock and you're like, man, I just made, $10,000 pretty much overnight. It's a $700 difference at the end of the day. You could probably get into a new position with your 10K that you profited, okay, and probably make up that $700 that year. But again, you're going to get taxed again on those profits. Now, there's also two things to consider when it comes to tax implications for certain types of retirement accounts. All right, if we talk about a traditional IRA, okay, if you want to go ahead and make moves in that traditional IRA, let's say, you buy a stock and you sell it within 365 days, the tax implications are 0%. Okay. The same thing goes for greater than 365. Going long, it's 0% gains. Okay. You can take all the gains. So if we took that 10K, okay, that we made before, there's nothing that's taken out into Uncle Sam. Now we can compound that money into a new trade and make another $10,000. Or the next trade, maybe it's even more because now we have, 20 grand we're working with. Maybe the next time we make, $15,000 and so on and so forth. You can totally trade your IRA. I don't recommend short-term trading it. You probably want to hold positions for a long time. But again, if those scenarios come up where a stock goes up 25% and maybe you're not super bullish, but hey, you made some money, sell out. You don't get taxed anything up until you take the money out at the age of 59 and a half. Okay, that's when you can first take out of a traditional IRA. But here's the kicker. You're taxed according to basically your ordinary income at that level. You're taxed at probably a lower income at the age of 59 and a half. Maybe you've retired, okay, so you don't have the extra income. So maybe you're taxed at those, 10, 12, 22% income levels. Hopefully you've saved a bit in retirement and you do get taxed at a higher rate with a traditional IRA, okay? And then this is the best one. If you go with a Roth IRA, if you sell short, you're at 0% short. If you go long, I'm so bad at this sometimes. Long, you're at 0% as well. And here's the great thing about it is that when you retire at 59 and a half, you got to wait. You're taxed on those gains 0%. The Roth IRA is the best instrument of all of them to do short-term trading or long-term trading in for the most part. So if you start young, while you can contribute to a Roth IRA, I highly recommend you do it. I didn't do it as much as I should have. I have rolled over from a Roth 401k to a Roth IRA, but I only have a couple $1,000s. It's not very much. Right now I'm doing a Roth 401k, so I'm starting to pile in money. And maybe, if I do retire from that company, I could end up rolling it over into a Roth IRA, and I could take advantage of this 0% gains. So that's something to consider. And also remember too, one thing, here, let me go back to full screen. One thing you got to remember is that your employer, guys, your employer is not taking into account any of these gains, okay? Your employer sets aside money every single check to account for the salary that you have there. So let's say your salary is in the $100,000 range. You're probably getting taxed around 24%. Again, it's graduated, okay? So you get taxed at 10% up to $47,000 or whatever it was. Let's see. I got the chart here. 10% up to $11,000, so on and so forth. You get taxed at each portion. Your employer is keeping track of that. They're not keeping track of your gains in the stock market or your gains, let's say, with YouTube or whoever it is you're doing business with, your side hustles. The stock market is like a side hustle, okay? So if you make $10,000 and let's say you make $3,200, you're going to owe that to the government at the end of the year because your employer does not take that money out. So be aware of that. Is set the money to the side. If you make 10 grand, set aside 5 of it. Don't spend all the rest, the other 5, and just keep that in mind. That's part of good old Uncle Sam. They get their cut. So anyways, hopefully this helps you guys out deciding whether or not you want to take profit early, whether it's less than 365 days. Or you want to go long and stay under that tax bracket, stay at that 15% tax bracket. So it's up to you. And if you guys could, like and subscribe to the channel. Take a look at my previous video. And everyone, have a great day. Thanks.